Yeah. Okay. Welcome to our another session, and thank you very much for joining on time. And today our topic is on revenue share on blockchain. So today our agenda that we will have 4 sections. The first one, Johannes, which he comes back as another guest speaker for today. He will talk about the ideas of revenue sharing, and then the question is why should it be on blockchain, and then the solutions with 2 tokens. And lastly, we will have the Q&A session, and then you can ask any questions you have by writing in the Q&A window on your left-hand side. And then we will try to answer all the questions, but maybe there's a limitation of time, but we will see. And lastly, after the session finished, you will also be able to rewatch it on our YouTube channel. And then we will also update you for the future webinars through email. So next, I will pass it on to Johannes for the presentation.
Thank you very much, Yasi, for the introduction. And welcome everyone to today's seminar. So, about myself, my name is Johannes Schweifer. I'm a technician, actually an engineer, chemist, not an economist. I spent many years actually in my original profession as solution architect and project manager with some big software systems. In 2013, I co-founded Bitcoin Swiss, which maybe the one or the other might know. It's one of the biggest brokerage companies for cryptocurrencies in Switzerland. And today I'm CEO of CoreLedger. At CoreLedger, we develop token economy solutions. So the idea of revenue sharing. Revenue sharing by itself is a concept which is not new. So people invested over a long period of time already money into businesses. Those businesses, at least some of them, tended to generate revenue and profit. And that profit was shared to the investors. We know this as a dividend. That's a classic model and already known since a long time. To use, however, setting up such a model requires some effort, and that effort is not to be underestimated. For example, you have to found a company. You have to make a prospectus, find investors, sell those tokens, sell those shares before you can sell them, list them on an exchange maybe, or sell them through brokers. However, you always have to audit the business, especially before you sell anything. And last but not least, after all hassle with legal and other things, you have to finally also provide some money, which means making money and making profit. However, we know other models of funding which are more fit for some smaller projects. Let's say you want to do something simple, like throwing a big party or having some adventure, getting some piece of art funded. Maybe you want to restore a pirate ship or just organize an event. All that is already known too, and it's simply known as a form of donation. So people donate money for a good cause, but instead of later receiving somehow a revenue share, they receive a free goodie. So at the end, when the event happens, everyone goes home happy, and we use to call this a crowdfunding event, and it's not exactly revenue share. The problem, however, is at present, there is not much in between this classic share plus dividend model and crowdfunding. So the question is now, could blockchain solve that problem and allow to find something in between? So there are a couple of assumptions. First, the assumption is that investors prefer to be paid in fiat currency. That means cash, Swiss francs, US dollars, euros, money, not Bitcoin, not some tokens, no promises. Second, investors prefer to receive the money monthly or even daily, over being paid the revenue share only once a year, which is the case with a dividend, for example. Third, there is a barrier with minimum investment. The price of a share cannot be infinitely low. So there's a minimum amount and also a minimum amount of investment into companies. Removing that barrier would mean that a bigger number of people get the opportunity to invest. That ultimately means that the total investment amount is higher. So what's the consequence? Doing this, realizing these assumptions, making them become facts, means that it's not possible with the standard model of owning shares and receiving a dividend. So how can blockchain really help? Blockchain has a lot of advantages. First of all, it is very simple to create such a certificate, which grants the holder a share of the revenue. We call this a token. Instead of needing a shareholder register, it's not ruled out, however, but instead of needing a shareholder register, it is very simple to obtain proof who is a holder of tokens and who is not. That's something inherently coming with blockchain technology if the blockchain is public. Then transactions on blockchain cost only a fraction or nothing at all compared to bank transactions. So if we really want to do monthly or even daily transactions, a blockchain transaction would not incur any transaction costs, or at least very little. Whereas a bank transaction, especially in foreign countries, would be quite costly. Transactions on blockchain are fast. Instead of waiting for several business days until a bank transaction is realized, a blockchain transaction is done in seconds or minutes. And it is possible to create tokens which represent a very small fraction of the business. So there is a minimum amount to which you can fractionalize a share or equity, in fact. One share cannot divide it further down, and law only permits a certain minimum value per share. But that's not the case with tokens, to be fair, at least not yet. However, tokens, they have also a global reach. They can be traded 24/7, and selling tokens, or for that matter also obtaining tokens, is much simpler than trading shares. So how would that model look like? And I'm going to present you an example how we realized it on CoreLedger. First of all, the secret ingredient, it needs two tokens, at least two tokens. The first one is the so-called revenue share token. This is the token which investors buy. Investors hold it. It's same as equity. So, of course, it could be traded on the secondary market. It could appreciate in price, just like a share. Let us take a real estate token, for example. And secondly, there is the payout token. The role of the payout token is very important. It serves as a placeholder, a so-called IOU, and it's denominated in a specific currency. So the investor first gets a payout, his revenue share, in the form of this token. Let's use a Swiss franc token, for example. It comes in 4 simple steps. First step is the creation of such tokens. The creation of such tokens are pretty simple. I'm going to show this in the white labeled marketplace, which simply allows to create new assets, give them some property, for example, some jurisdiction, US, United States, some type, could be real estate. We give it a unit of measure that could be tokens or each or piece, depending on each issuer's preference, and we can enrich the properties however we like. Extend it with the company which issues the shares and the tokens and so forth. And the same with the Swiss franc token. Activating it, puts it on blockchain, and that's it. Secondly, step number 2 is the revenue share itself. Depending on how the model is calculated, a revenue share is based on earnings or the profit of the business, in this case, the apartment. Assuming that the apartment generates revenue in the form of rent, then real money comes in. The real money is, of course, somewhere stored on a bank account. Could be Swiss francs, could be US dollars, could be euros, does not matter. However, there is a certain model which converts the Swiss francs earned per revenue share token into the Swiss franc tokens. That could be monthly, could be quarterly, could be weekly, could be daily, depending on how quickly the numbers are known. In this model, in this example, it's for example 0.00358 Swiss franc tokens per revenue share token. Let us assume investor A holds 1,000 of these tokens. So he gets a mere 3.58 Swiss franc tokens that month. That's fine. Each investor has to be paid out in the same manner. So the distribution of payout tokens happens on a key press by the issuer. And of course, this can be automated. Meaning that you can serve thousands or 10 of thousands of investors, regardless the size of their investment. And since it's a token and not a bank transfer, the cost of this transfer is pretty low. Step number 3. The investor needs to accumulate those tokens. Instead of just getting a payout immediately, the investor can actually see every month how many tokens accumulate on his account and choose the time of payout. Lastly, doing the payout means redeeming the tokens, means conversion of the Swiss franc tokens into the real money. The investor chooses whenever he likes to send the Swiss franc tokens, like in some form of a voucher, back to the issuer, and he receives a bank transfer with the real money. I would like to show you this. So it is actually a pretty simple process. First of all, there is the choice how the transfer should happen, which is a conversion of the amount selected into a certain payout method. Let's choose bank transfer for simplicity. The user, after having been registered, has to fill out some forms. Of course, bring some random data. After agreeing to the terms, the user is simply presented with a QR code. And what I want to show you now is the entire setup, which involves also an app. This is the screen share of the app at the moment. The app shows an overview of assets, for example, the real estate asset, luxury living in New York, and the Swiss franc token, which is constantly earned month by month by this revenue share model. This acts as a wallet, and this wallet also has a QR code scanner which can interpret, this is a good spot, which can interpret this QR code. So I change now to the QR code scanner, and you can see my screen. So I, as an investor, can now transfer the Swiss francs back to the issuer. I have to wait a couple of seconds until the transaction is confirmed, and transaction is confirmed. Everything else happens in the back end. Afterwards, the issuer will invoke a bank transaction and send the money to my requested address. So what did we gain with this model? What is the benefit? So if investors prefer to be paid in fiat currency, then this is possible. They can choose simply a bank transfer. It does not exclude other things like being paid in other tokens or being paid in Bitcoin. Ultimately, the bank transfer is possible. Number two, receiving the money more frequently than usual if I receive dividend is possible as well. It's actually the investor's own choosing when he wants to be paid. And removing the barrier of a minimum investment, practically, even a single investment token share could already yield Swiss franc tokens. So there is no limit to the downside, what is possible and what not. So that is the revenue share model based on 2 tokens and a process of using the claim to Swiss francs in order to redeem real Swiss francs, but only if a certain threshold has been exceeded so that the issuer can control the banking fees. Assuming that doing a foreign transaction or a transaction to a foreign country would incur costs of, let's say, 10 francs, 15 francs or something, he could set the minimum amount which can be redeemed to 1,000 francs. So only after 1,000 francs have been accumulated, the payout can happen. So for actually both the investor as well as the issuer, there is a win-win situation in that sense. And the model can realize payouts in real currency, in fiat currency. That's the achievement. Thank you very much for your attention. And if you have questions, I'm happy to answer them.
Okay, thank you, Hannes. We have few questions here. By the way, everyone, so you can write, if you see on your left-hand side panel, there's a Q&A there, then you can type your questions and then we will be able to see it, okay? So now we have one question coming from the audience, that what is the legal framework for this model?
The legal framework is based on the country in which this is launched. So Switzerland and Liechtenstein, they have some favorable conditions for that model. In the case you want to launch it here, then there are a couple of lawyers who are familiar with that kind of model and can help you, guide you through. Depending on the business. So if it's a revenue share, for example, on an event or something, fewer legal requirements might be necessary than if it's resembling a classical share and dividend model. Since I'm not a lawyer, I don't want and can't and should not dig too deep into it.
All right. Then let's see. The next one is, can I use CHF token also for the other things like purchasing something online?
Depends if those Swiss franc tokens are indeed accepted by, for example, another business. But practically, these are your own Swiss franc tokens. You are the issuer. So if you get somebody else to trust, under quotes, to trust these Swiss franc tokens of yours, then of course. But keep in mind, they are not generic Swiss franc tokens like money issued by a central bank or something.
Yeah, right. Still, yeah. Yeah, well, then we have another question is about this revenue share. So how is the revenue share token linked to the underlying asset? Is it kind of a utility token?
It could be a utility token, yes, but the linkage itself is being created or being documented by the issuer. So whatever the issuer chooses to base it on, it could be per square meter of an apartment, as I've shown. It could be I don't know, some space somewhere. It could be whatever, by energy generated by solar panels or something. And the proof that the underlying is there can also be given, for example, by third parties like auditors who also on the blockchain link their audit report with your asset and thereby prove that the underlying is there.
So I think you have answered this question. If you have more following questions, feel free to post it in the Q&A section, okay? So next we move to another question is how about legislation in Austria? Is it as friendly as in Switzerland?
That is a very good question. I refer to my answer, which I gave before. I'm not a lawyer. So since legislation is constantly changing and adapting, I can't say this. So
yeah, so better to consult a lawyer, right? Yeah. Okay, next question we have is why do I have to create my own CHF token? I could use an existing one, right?
Sure. But if you use an existing one, then you don't really have control over it. If you create your own one, you can always create more of it or destroy your tokens. You simply will not be dependent on somebody else's choosing and liking. It might be that, for example, another token just introduces transaction costs or interest, negative, of course, and other things which you can't control. And this could have significant impact on your business and, of course, on your, in this case, Swiss franc token holdings. So it's advisable to create your own Swiss franc token. It's anyhow just a placeholder. And there's one more thing. If you are to distribute somebody else's Swiss franc tokens, then you have to purchase them in advance, which also incurs some costs. So that's a couple of good reasons why to have your own Swiss franc token.
So as a business owner.
As a business owner, yes.
Yeah. Okay.
Not as an investor, of course.
Okay, let's see if we have more questions coming up. So right now I sent everybody the link where you can find our YouTube channel and all the webinar, like the recorded sessions will be uploaded there. So some of the sessions might contain a lot of information, so you can rewatch it later. Okay, I guess we don't have any other questions for today. Hannes, can you go to the next slide, please? Do you have, yeah. So here is where you can find us. We are on LinkedIn, Medium, YouTube, Facebook, and Twitter. We often upload videos about blockchain and also articles on Medium, where you can learn more about tokenization and our products. And if you have any more questions regarding the solution or your business model, how it can be integrated with ours, then please feel free to reach out to us either by this email or give us a call. And thank you very much for your participation today, and we hope to see you next time. Bye-bye.
Thank you. Goodbye.